What does this mean for oil prices? How much of a headache will they be, and how high can they go?
Thank you, and thank you for having me today. No, so we're seeing, as we say in our report today, oil demand is clearly slowing. Higher prices, the weaker economic outlook is denting oil demand. We're seeing signs of a slowdown in transport fuels. And in 2022, we're seeing oil supplies rising, being able to meet that demand mostly. But as we flip into 2023, as OPEC Plus bumps up against their capacity constraints, oil demand recovers, especially for China, the market are looking incredibly tight. And the buffers that we have, inventory, spare capacity in production, and refining capacity tight, the market is looking stretched.
So, Toril, given where we are, and given prices, I imagine, can really spike up, is there anything that you're hoping President Biden can achieve in his visit to Saudi?
Well, we're already seeing that the OPEC Plus agreed, as we know earlier this month, to accelerate the phasing out of production cuts that were expected to end in September. And now we're seeing slightly higher increases over July and August, and that's very welcome in a tight market. So we're hoping OPEC Plus spare capacity is concentrated in Saudi Arabia and the UAE primarily. And in this market, higher production will be welcome indeed.
What can heal the market? I mean, if it's not extra production, does the fact that certain refining capacity get back online, how much does that help?
So we're expecting now that refinery maintenance is coming to an end in Europe and the US and gradually in Asia as well. We are expecting a strong rebound in refinery activity from May to August, so about 3.5 million barrels a day. That will help ease market tensions in the products. Moving into 2023, we're also seeing a number of new refineries coming online end of this year, next year in Africa, in the Middle East, China. This will also help ease the tensions that we're seeing now in product markets.
So, Toril, overall, and I know you hate discussing prices, and rightly so, because they're so impossible to predict, but are we really in a danger zone? Could they even go above 150?
I think there is a lot of risk that we see in the market today. Most recently, we're seeing production in Libya falling due to unrest there. We heard just a few days ago that Libyan production fell to 100,000 barrels a day. This is obviously coming at a very crucial time as European refiners are looking to increase refining activity and are looking for those sweet barrels to produce gasoline and diesel ahead of the summer season. We're also seeing there have been news about forecast about a very active hurricane season in the U.S. this year. With such small buffers in the market, as I said, inventories are 300 million barrels a day below their 5-year average. Product inventories are very low, and with spare capacity, we don't have the buffers today to offset any unforeseen losses elsewhere. So I think the market would remain volatile, and clearly there is a risk that prices will move higher. But as we heard, with inflation running ahead, the weaker economic outlook, as we move forward, demand risk could also be to the downside.
How difficult is it to see when the resurgent Chinese economy also bolsters consumption? Is there peak oil demand sometime right before the winter of 2022, or what's the timing for that?
So in our forecast, we're not seeing peak oil demand in this horizon. For China, the losses that we've seen due to their COVID restrictions have been much more severe than expected. Chinese oil demand in April and May were 1 million barrels a day below last year. And we're seeing that we're expecting a gradual recovery in Chinese demand through the rest of the year. We're seeing restriction easing, but our forecast now is that Chinese oil demand will decline for the first time on an annual basis in 2022 in more than 20 years. But as China recovers, that will increase oil demand growth in 2023. So we're actually seeing higher oil demand growth next year compared to this year, despite the deteriorating economic outlook and higher prices as China rebounds. So Chinese oil demand in our forecast will grow by 1 million barrels a day next year, taking global oil demand up by 2.2 million barrels a day compared to the 1.8 that we forecast for 2022.